the macro scene continues to look pretty gosh damn shaky, and we as cryptocurrency investors really need to be paying attention to this because we have seen incredible correlation recently between the cryptocurrency markets and top stock indexes in the United States. So in today's video, I want to share with you the 5 biggest things that you need to be keeping an eye on in the market right now that have the chance to either positively or negatively affect the equity markets and vicariously the crypto markets. My name is Lark. Every day I make cryptocurrency videos. If that is a topic you do like learning about, you like keeping up to date with, then we'll tap on the thumbs up button just to tell me that you're awesome. Would be super freaking cool. By the way, every single week my team and I produce Wealth Mastery. It's a cryptocurrency investor report. We talk about DeFi, altcoins, NFTs, and much, much more. You can sign up for free using the link down below in the description. Now, I just want to jump straight into this topic. It's a big doozy of a topic. We're going to start with talking about recession. Bank of America, latest major institution to deliver a grim warning for the future. Recession is coming. Recessions happen. Recessions are a normal part of economies. Recessions are a normal part of markets. And after the good times and all the free money that was happening over the last couple of years, a recession becomes increasingly likely, especially with all the stuff going on that we're going to be talking about in today's video. Now, the question becomes, of course, well, if we do get a recession, it has not been confirmed yet, although we're very much heading in that direction. But if we do get a recession, well, what does that mean for the equity markets and therefore our crypto coins? Well, how do stocks perform around recessions? As we can see from this chart here, let me just make myself a little smaller so you can see all the data there. As you can see from this chart here, when we have recessions, usually stocks perform their worst 6 months to a year before the recession happens. During the recession, we tend to get a lot of positive returns. So this is before. You can see a lot of negative returns leading into the recession. During the recession, we tend to get some moderately positive returns to some pretty shockingly bad returns, like of course here in late 2007, finishing down 37%. But often we also get mildly positive returns. And then after recessions, we tend to see markets moving pretty quickly. So we can see a lot of returns coming back in just after the recession has finished. So most of the time, by the time a recession has been declared, stocks have already done a lot of their bleeding. Not all the time. Of course, 2007, 2008 was an obvious situation when that was not the case. But as we can see here, for the most part, you're not going to get a lot of returns during the recession, but it also won't be that bad. By the time the recession's happened, most of the bad stuff has already happened. Now, the other big thing weighing on the market we have to talk about, of course, is the rate hikes. So the Federal Reserve has started raising interest rates again. We've been talking about that a lot here on the channel. Now, how do stocks perform during Federal Reserve rate hike periods? Well, as we've discussed here on the channel, initially, there tends to be a bit of a shock period. Now that can be in the first week or two, and it can last as long as a few months after the rate hikes are announced, where we see markets correcting down 5-10%, taking a long time to get back to the price they were when the rate hike was announced before we start moving back up and getting new gains. So the key thing here is that after a year, we tend to have positive returns. So the first 3 to 6 months can be shaky. After 6 to 12 months, we tend to get a positive return. And if we look at the entire period of rate hike cycle, well, we see that in almost every situation, it has resulted in a positive return for the stock market. What's good for the stock markets, as we know, because of the high correlation, is good for the cryptocurrency markets. Now, what about inflation? We're talking a lot about inflation. We just got the CPI data for March. Obviously, everything is very cool and normal with an 8.0 8.5% rate of inflation, which is absolutely crazy high inflation. At that kind of a rate of inflation, like, it's just nuts. Your money's just flying out the window on a daily basis if you're, of course, sitting in huge amounts of fiat. So, wowzers, man. Inflation absolutely going nuts. Now, how do markets tend to perform during inflationary periods? Well, as we can see here, when we have high inflation, and look, the 8.5% inflation, by the way, is a pretty damn high number, but it doesn't fully represent all the inflation happening. See, because while something like beer has only gone up 3%, your rent may have gone up 17%. Your chicken might have gone up 17 or 18%. Your price for fuel may have gone up 20, 25%. We even see skyrocketing inflation in places like Germany, where we've seen 20 to 50% increases on some food items, which is mind-boggling, will really hurt people living on tight budgets, obviously. So when we have a situation as we have right here, this is the bar we need to be paying attention to, where we have high inflation, that's inflation over 3%, plus it's rising, so that's exactly what's been happening to inflation for the last, quite while now, where inflation continues to go up, reaching crazy numbers now. Not over yet. I would not be surprised to again see April put in an even higher number for inflation. Anyway, during these kind of market situations where you have high persistent inflation that keeps rising, there's only a 48% chance that equity markets will exceed the inflation rate over a 12-month period. That means that it is unlikely that the key stock indexes are going to return more than an 8% return, which, honestly, if the key stock indexes did return like a 7 or 8% return during the next 12 months, it would actually be pretty gosh darn good. Obviously, that would line up with our Fed rate hike, which tends to see a 7 to 8% return for equity markets in the 12-month period following a rate hike. But it's a flip a coin kind of situation of whether or not we're going to beat that inflation rate, because the inflation rate is so damn high right now. So markets may underperform versus inflation unless the Fed can really start getting inflation down in the very near future. Fourth thing we have to be keeping an eye on, obviously, the war is not over in Ukraine. This is a big deal for a lot of products globally. Ukraine is a massive producer of a lot of key food products: wheat, vegetable oil, corn, grains, the things that make bread. People in countries all around the world rely on these foodstuffs. And if Ukraine's supply is not going into the market, let's say they're just throw a number out here, 10% of the global market, well, suddenly you've got a massive shortage on your hand, which is going to send prices sky freaking high, causing massive food insecurity. And look, revolutions have literally happened over the price of freaking bread before. Governments have been overthrown over the price of bread. So this potentially looks at massive disruption to political systems, massive hunger crises, and all of these kinds of things. So it has a lot of far-reaching effects beyond the borders of Ukraine. And of course, we also have the issue of, what's going to happen to the price of fuel, especially for the transportation of goods? How much of that's going to get passed on to consumers? Probably all of it, of course, making it even more expensive to buy the basics for people on the tightest incomes in the world. It costs more to get the food to you, and there's less of it available, meaning the prices could continue to go higher. Inflation could continue to go higher for key products. So how the war plays out, and of course we have to talk about the energy prices too. Russia's one of the world's biggest producers of oil and gas. The knock-on effects of that still to be seen. And the final thing that we have to take note of is, of course, the Federal Reserve bringing up the possibility of selling mortgage-backed securities. Now, they have announced that they're going to be drawing down up to $95 billion a month worth of the assets that they currently hold, which is a lot of money and sounds really scary when you hear it, because they do hold $9 trillion worth of assets, which is mind-boggling that it got so out of control. But the U.S. economy has been out of control for a while. $30 trillion in debt. I mean, that's nuts, man. Anyway, that's going to be a whole different tangent, a whole different video. The reality is $95 billion a month in Fed holdings are going to be gotten rid of. Now, the key thing to note here is that most of it's just going to be rolled off. So that means when, the Treasury bond comes to its expiration date, they're simply not buying more of them. That doesn't have the kind of impact on the market where there's mass selling, huge amounts of bonds or something like that. No. But if they start selling mortgage-backed securities, that could put a huge amount of pressure on equity markets, which would not be good for crypto markets, obviously. Now, those are the 5 big things that are happening. And look, with so much fear, so much uncertainty, the sentiment in equity markets being pretty rough, the people, worried about inflation and all this stuff, we have to keep in mind it is going to be harder for people to keep buying monkey pictures. We all love monkey pictures, but if you're worried about how you're going to put food on the table or how you're going to put fuel in your car to get to work this week, you're a lot less likely to buy a monkey picture or a speculative altcoin or even Bitcoin to make any kind of investment, stocks or anything else. With inflation soaring, food, rent, and fuel all being 15, 20, 30, 40, 50% more expensive, probably going to keep rising as the uncertainty around what's happening in Ukraine continues to persist. People are going to be saving more money, spending less money on speculative assets like cryptocurrencies or even just stocks. People will be investing less. They're going to be putting money in the bank, but then they're getting hit with inflation. Damned if you do, damned if you don't. They should be buying Bitcoin, but I understand why they may not be, because the fear is real in the markets. Now, a thought that I had as well, and I want to finish up the video with this. If we do get, the terrible recession happening, inflation continues to go totally nuts, and the Fed rate hikes crash the market, and the war in Ukraine persists, and food prices go crazy, and all this stuff, lots of people are going to lose their jobs, which is terrible. Obviously, you don't want people losing their jobs or their livelihoods. It's horrific. That being said, crypto could pump super hard in this situation. Well, we could have millions of people suddenly going, holy crap, there's play to earn games where I just play video games and they give me money every single day, or move to earn apps. I just got to go out and walk around my town and they're going to pay me money. That's crazy. Or I can go in and, get multi-100% returns on some DeFi yield farm. That's crazy. I'm going to do that. Or I can start trading and making money, or I can start flipping monkey pictures and making money. People are going to flip onto all this stuff. Plus, if it gets too bad, there's going to be a stimulus package. They're going to have to get those checks out to people, which pump up the markets once again. Central banks have lost control of the situation, realistically. So, look, there are things we have to be paying attention to. I am a very optimistic person. I remain optimistic on the cryptocurrency asset class. Even if we have some turbulence over the short term, just fasten up your seatbelts. We will get through it. All of this stuff will come to an end at some point. How soon, of course, is the question. And I hope for sooner than later, but a lot of this stuff could be persisting with us throughout the year. Anyway, just my 2 Satoshis for the day. You'll let me know what you think about any of this stuff down below in the comment section. Thanks so much for watching today's video, and peace out till next time.